welcome you to the deep dive. If you're looking for a shortcut to truly understanding what's moving the markets, the economy right now, well, you've definitely come to the right place. Today, we're taking a deep dive into this really in-depth 2025 sector analysis report. It was prepared for a US Equities Trading Desk, and it's current as of today, Friday, September 5th, 2025. Our mission: to pull out the most important nuggets of knowledge from this pretty comprehensive report. We want to cut through all the noise, show you the four major forces creating these significant and sometimes conflicting cross-currents in the U.S. equity market. These themes, they're shaping pretty much everything, and they demand a really selective approach to figuring out where capital is flowing. So let's unpack this. Okay, so let's kick things off with the first big theme the report brings up: stagflationary crosswinds. Sounds a bit complex, maybe like a weather forecast gone wrong, but it's essentially a tug of war, right? Exactly. It's this push and pull. Slowing growth meeting, well, sticky inflation.
Precisely.
Yeah.
And a key insight, really, from this report is that we're seeing that decelerating economic growth paired with inflation that just won't quit.
Yeah.
Global growth forecasts are consistently being revised downward. That's because of ongoing geopolitical tensions, a rise in protectionism. It's all having an effect.
Yeah.
And for the U.S. specifically, GDP growth forecasts for 2025 have moderated quite a bit. They're now in the 1.6% to 2.0% range.
Okay, so growth is slowing down.
Right. But simultaneously, inflation remains surprisingly stubborn. I mean, the most recent data we have for July 2025 shows headline CPI inflation at 2.7% year over year. And core CPI, the one that strips out food and energy, that actually accelerated to 3.1%.
And that's the real head scratcher, isn't it? If the economy's slowing, why is inflation still so high? Usually those things don't exactly go hand in hand. What's so unique about this policy-induced stagflation the report mentions?
Yeah, that's where the nuance really lies. The report specifically points to this as policy-induced stagflation. It's driven heavily by these aggressive tariff policies that were implemented back in early 2025. What's truly insightful here, I think, is that this isn't your typical inflation from, say, an overheating economy with too much demand.
Right.
No, this is more of a structural cost-push inflation, and it's directly engineered by policy. These tariffs, well, they're a dual-edged sword. On one hand, they drag on GDP growth because they depress trade, they create uncertainty for businesses.
Makes sense.
But at the same time, they act as a direct inflationary force, they raise input costs for manufacturers, and they increase consumer prices for anything imported, and this creates a uniquely thorny problem for the Federal Reserve. Because their typical response to slowing growth, easing monetary policy, cutting rates that's severely constrained by this tariff-driven inflation,
Right.
They're really in a tough spot.
Okay, yeah, that makes the Fed's next moves incredibly critical. And the report suggests the whole higher for longer narrative for rates. That's definitively ended, which is a massive shift.
A huge shift.
But hang on, if inflation is still sticky because of those tariffs, like we just discussed, isn't the Fed risking a huge credibility problem by pivoting dovish right now? How do they even balance that?
That is precisely the tightrope they're walking. You've absolutely hit on the core tension here. You see these weakening labor market indicators like that lower than expected 54,000 jobs added in August, according to ADP, and the rise in jobless claims.
Yeah, I saw those numbers.
Those have really cemented market expectations. These signals are pushing the FOMC, the Fed's policy committee, to initiate a rate-cutting cycle, probably at its upcoming meeting, September 16th, 17th. Market-implied probabilities, from the CME FedWatch tool, they indicate something like an 85% to 90% chance of a 25 basis point cut.
Wow, that high.
Yeah. And Fed Chair Jerome Powell's recent speech at Jackson Hole, where he acknowledged this sort of evolving balance of risks, that basically paved the way for this. So the thinking is the central bank is initiating more of a preemptive easing cycle, trying to prolong the economic expansion rather than reacting to some kind of collapse.
Okay.
The base case now is a soft landing, which, is generally favorable for risk assets, for stocks.
So the market seems to be pricing in a pretty smooth ride then. But is there a risk here? Could this optimism be a little too, complacent?
Absolutely.
Could the Fed find its hands tied if that tariff-driven inflation just refuses to budge?
That's definitely a key risk flagged in the report. The market might be overly complacent, that sticky tariff-driven inflation. It could limit the Fed's ability to ease as aggressively as the futures markets are currently pricing in. If the inflation data surprises on the upside, maybe later this year, or if those tariffs prove even more persistent than people think,
Right.
it could lead to what the report calls a hawkish disappointment.
Right.
That would throw a real wrench into that soft landing narrative. It's a very delicate balancing act. The margin for error is pretty slim.
Okay, so we've seen how tariffs are kind of tying the Fed's hands, creating these stagflationary pressures. But those tariffs and the broader geopolitical landscape, they're doing more than just impacting monetary policy, aren't they?
Oh, much more.
They're creating this massive wave of uncertainty across the whole market. Which brings us to the next major theme: pervasive tariff and geopolitical uncertainty. This isn't just a minor detail, is it?
Not at all. It's really a defining feature of 2025. The implementation of these broad-based reciprocal tariffs under the IEPA has pushed the average effective U.S. tariff rate to its highest level in well over a century. And the true insight here, I think, is the paralyzing effect of this unpredictability. It has profoundly disrupted global supply chains. It's significantly increased costs for businesses. And crucially, it's paralyzed long-term capital investment decisions. Companies are struggling to predict future trade relationships.
Yeah, how can you plan?
Exactly. The World Trade Policy Uncertainty Index, it reached record levels in the first quarter of 2025. That just perfectly illustrates the sentiment out there. And this trade friction, it's layered on top of an already tense geopolitical backdrop. Deepening U.S.-China strategic competition, other global hotspots. This whole environment is forcing a strategic bifurcation in the market. It's creating clear tariff winners, think companies with mostly domestic operations, or maybe those benefiting from onshoring effort.
Bringing manufacturing back.
Right, and then you have the tariff losers, those with complex global supply chains, high import dependency. They're feeling the pain.
So if I'm a company, say, relying heavily on imported components, I'm really feeling the squeeze. But if I've already moved my manufacturing back home, maybe I'm actually doing okay or even thriving. It's forcing a complete rethink of business models.
Exactly right. It's a major strategic shift. It means companies are actively looking at geographical diversification, regionalization, rather than just pure globalization, like we saw for decades. This creates very, very different operating environments depending on how exposed a particular business is to these trade winds.
Okay. So amidst all that complexity, all that uncertainty, there's one powerful secular growth theme that's kind of emerged, providing this compelling counter-narrative, the report calls it, the AI-driven infrastructure supercycle. Okay, let's unpack this one. It sounds almost like science fiction, but it's fundamentally reshaping our economy, isn't it?
Yeah.
How exactly is AI creating such a profound demand shock right now?
It truly is transformative. And a key insight here is the sheer exponential growth in AI. That's creating an unprecedented demand shock for infrastructure, both digital and physical. Think about the hyperscale cloud providers, Microsoft, Alphabet, Meta, Amazon. They're projected to spend something like $350 billion just on data centers and related AI infrastructure in 2025 alone.
350 billion.
Billion, with a B. That's an astounding 80% increase from the prior year.
Wow.
And this massive digital build-out, these huge computing factories, they are in turn creating an unprecedented demand surge for electricity. After, more than a decade of pretty stagnant growth in U.S. power demand, it's now projected to grow significantly year after year, and it's almost entirely driven by these new energy-intensive data centers and, to a lesser extent, manufacturing reshoring, too.
And here's the paradox that really jumps out at me. AI is often talked about as the ultimate deflationary force, right? Because of its productivity potential.
Long term, yes. Yet you're saying its immediate effect on infrastructure is actually inflationary because it demands so many scarce resources. Can you elaborate on that? And what does it mean for those picks and shovels investments you mentioned?
That is the crucial tension, spot on. While AI's long-term promise is absolutely about boosting productivity, potentially lowering costs across the economy, making it fundamentally a deflationary technology,
Right.
its immediate second-order effect is highly inflationary. Why? Because it demands enormous amounts of scarce physical resources. We're talking vast quantities of electricity, specialized real estate for data centers, advanced cooling systems, and of course those cutting-edge semiconductor chips.
The building blocks.
Exactly, the building blocks. And this presents a very tangible multi-year investment opportunity in what we call the picks and shovels sectors. You might not be directly investing in the AI models themselves, but in the foundational elements that enable them. It's like investing in the tools during a gold rush, yeah. Got it. Okay, so what does all this mean when we look at individual sectors? These overarching forces, stagflation, AI supercycle, tariffs, They're creating some really dramatic divergences, almost pulling sectors in completely opposite directions. Let's zoom in on a few where these themes are playing out most dramatically, starting with the one right at the heart of the AI revolution, information technology. It's up, what, plus 13.3% year to date? Still the market's growth epicenter. Clearly, AI is the dominant story here. But how many layers are there to this AI investment supercycle?
Oh, there are several critical layers, which is actually what makes it so robust, so durable, perhaps. First, you're talking about a semiconductor boom, specifically for advanced AI accelerator chips, the literal brains of these powerful AI systems.
The GPUs and things like that?
Yeah, precisely. Then there's the massive cloud infrastructure build-out we just touched on. Hundreds of billions being invested in actually constructing and equipping those huge data centers. And then maybe the next wave is an enterprise software transformation,
Yeah.
where generative AI capabilities are being embedded directly into existing platforms. Think CRM, ERP, to automate workflows, create new applications.
That makes a lot of sense. So for investors, the report highlights two key theses here in IT. The first is to overweight semiconductors and AI infrastructure providers. This is really about investing in the foundational hardware for AI, the absolute necessities, right? The picks and shovels again.
That's the fundamental premise. And the report stresses it's not just any hardware, it's incredibly specialized chips and the specific infrastructure needed to house and power them. This is creating a demand cycle, unlike pretty much anything we've seen before. Global spending on AI, projected to grow at a nearly 30% compound annual growth rate, CAGR, through 2028. That's huge.
Huge growth.
And the semiconductor industry itself is projected to grow over 11% in 2025. That hyperscaler capex, that $350 billion figure for 2025, it just reinforces this as a definitive picks and shovels play. How do we know if it's working? Well, we'd look for continued upward revisions to capex guidance from the big cloud providers and consistently strong earnings from the key semiconductor companies.
Yeah, the risks.
The risks, of course, include maybe a significant slowdown in actual enterprise AI adoption companies deciding it's too expensive or not ready yet, or stricter government export controls, especially on advanced chips, could disrupt supply chains. And there's always the risk of rapid tech shifts making current hardware obsolete faster than expected.
Okay. And the second thesis here in IT is to overweight enterprise software companies that have embedded AI capabilities. So the idea is the next phase shifts from just building the foundation to actually putting AI to work, rewarding established software companies that integrate AI into their existing platforms.
Exactly.
This is where we might see things like agentic AI come into play. That sounds pretty futuristic.
It does, but it's coming. The next frontier is likely less about just raw computing power and more about the applications. Businesses are really seeking practical AI use cases, things with a clear return on investment, and efficient deployment through existing familiar platforms like their CRM or ERP systems. That's key for adoption. The incumbent software giants benefit immensely here because they have massive installed customer bases.
Right, easier sell.
Much easier sell. And yes, the shift towards agentic AI, where AI systems can act more autonomously to achieve complex goals without constant human prompting, that's a major long-term driver. It could transform how tasks get done across countless industries. What are the validating conditions here? We'd look for announcements of new AI-powered product suites, evidence of strong customer adoption, signs they're successfully monetizing these features in their earnings reports.
And the risks on the software side.
Well, risks include incumbents maybe failing to innovate quickly enough, getting leapfrogged by startups, or customer pushback on the pricing of these new AI features. And importantly, ongoing concerns about data privacy and security, especially as AI gets more autonomous.
Okay, now here's where it gets really interesting for me. Utilities. Traditionally, you think of them as, well, a bit sleepy, right? A defensive sector, usually driven by dividends, not exciting growth.
Pretty much, yeah.
Yet they've delivered a strong plus 12.2% year-to-date performance according to this report. What's truly re-rating this sector? What's driving such unexpected outperformance?
Yeah, it's quite a shift. A key insight here is that the AI-driven power demand surge we discussed, it's the single most dominant theme, and it's fundamentally re-rating the entire utility sector. Remember, after nearly 15 years of basically flat electricity demand in the U.S., forecasts now project sustained annual growth of maybe 2–3%, possibly even more, for the foreseeable future. And this is almost entirely driven by the relentless construction of those energy-guzzling data centers. They are just insatiable power consumers. So this effectively transforms the whole utility investment thesis. It's moving from just a simple defensive yield play.
Boring but safe.
Exactly, to becoming a secular growth story because they need massive capital investment now for grid modernization, for new generation capacity. So the core idea, the thesis here, is to overweight electric utilities specifically because of this secular AI-driven demand growth.
So let me get this straight. If I'm a utility company and suddenly I find out a massive data center is coming into my service territory and it's going to drive maybe 8% annual retail sales growth just from that one facility, how do I even begin to plan for that? It sounds like an enormous challenge, but maybe an incredibly lucrative one.
It is a phenomenal opportunity, but also a huge challenge, you're right. This unexpected surge in demand requires truly unprecedented capital investment. They need to upgrade existing grids, build new substations, bring entirely new power generation online, whether that's gas, renewables, maybe even nuclear down the line.
Right.
And all that investment, if approved by regulators, drives growth in their regulated rate base, which ultimately drives earnings growth for these utilities.
Hmm.
What's often underappreciated, I think, is the sheer scale and the long-term nature of these necessary projects. This isn't a 1 or 2 year thing.
Decades, maybe.
Potentially. So what do we look for? Continued upward revisions to those load growth forecasts from the utility companies themselves, announcements of large-scale data center developments within their specific service areas, and critically favorable regulatory outcomes that allow them to recover these huge capital investments through higher rates over time.
And the risks for utilities.
Well, a significant slowdown in AI development would obviously hit demand forecasts. Major technological breakthroughs in AI energy efficiency could dampen demand growth. And a hostile regulatory environment where they can't get rate increases approved to cover investments, that would be a major problem.
Okay, moving on. Real estate. It's been a mixed bag this year. The report says up only plus 3.6% year to date. But it points to this dramatic divergence, almost a tale of two markets between different property types. So what does this all mean for real estate right now? What's driving this split?
Yeah, it's definitely a split market. From a broader perspective, the whole sector is highly sensitive to interest rates, right? So the Fed's potential dovish pivot, that's a major potential catalyst for REITs generally, could help. But the key, as you said, is precisely that bifurcation. You have these secularly growing subsectors, like data centers, performing incredibly well. And then you have structurally challenged sectors, like traditional office space, which are really, really struggling. So the first thesis here, not surprisingly, is to overweight data center REITs real estate investment trusts, seeing them as a core AI infrastructure play.
And that makes perfect sense, tying back to our earlier discussion about the AI supercycle. Data center REITs are basically the landlords for the digital age, aren't they?
They absolutely are. Essential infrastructure. Demand for data center space is just skyrocketing because of AI. There are estimates out there saying something like $2 trillion in investment is needed globally by 2030 just to meet this demand.
$2 trillion, that's enormous.
It's staggering, and this creates a landlord's market. You're seeing strong rental growth, incredibly low vacancy rates in prime locations, and these REITs are signing long-term leases, often 10, 15 years, with very high credit tenants, the hyperscalers we talked about.
Stable income stream.
Very stable. So, validating conditions. We'd look for continued high capex announcements from the big tech companies, strong leasing spreads, that's the difference between old lease rates and new ones reported by the data center REITs, and further upward revisions to electricity demand forecasts, which often precede data center construction.
Risks for data center REITs.
Risks include, again, any significant AI-related spending slowdown hitting demand. Maybe technological shifts towards more distributed computing models that need less centralized space, though that seems less likely near term, or simply overbuilding in certain geographic markets, leading to increased vacancy down the road.
Okay, and then on the flip side of that divergence, the report suggests underweighting office REITs. It paints a pretty bleak picture for traditional office spaces. The report mentions a debt cliff. Can you explain what that implies beyond just, loans coming due?
Right. It's more than just loans maturing. The traditional office sector faces really significant structural headwinds, primarily because of the permanent shift towards hybrid work models. That's the core issue.
People aren't coming back full time.
Many aren't. National office vacancy rates. They reached a new record high of 20.4% in the first quarter of 2025, according to the report. And what's truly concerning is that older, lower quality buildings, Class B, Class C offices, they face potential obsolescence. They're struggling to attract or retain tenants who now demand higher amenities. This leads directly to that debt cliff concept. There are trillions in commercial real estate loans maturing over the next few years. But property values for many office buildings have fallen so significantly
Right.
that the new financing available often can't even cover the original loan amount when it comes due. This creates immense pressure. It could lead to defaults, distressed sales, or landlords being forced into painful recapitalizations. It's a very challenging environment for many office owners.
So what would confirm this negative view?
We'd look for further increases in national office vacancy rates, persistent negative rent growth, especially in those older buildings, and crucially, an increase in loan delinquencies or defaults reported by banks and lenders.
And the counter risk. What could make the office outlook less bleak?
Well, a really widespread, aggressive corporate push for full return to office mandates could help demand, though the trend seems against that. Successful, large-scale office-to-residential conversions could remove supply. Or a really sharp, unexpected drop in interest rates might ease some refinancing pressure, but the structural demand issue remains.
Okay, final sector deep dive. Energy. With a modest plus 5.4% year-to-date gain, the report describes it as being caught in a tug of war. Let's unpack this. What are the conflicting forces pulling this sector in different directions?
Yeah, tug of war is a good way to put it. What's truly insightful here, I think, is the deep conflict playing out. On one side, you have persistent geopolitical risks, tensions in the Middle East, Russia, Ukraine, etc. Historically, that provides a floor, some support for energy prices.
The risk premium.
Exactly, the geopolitical risk premium.
Wow.
But on the other side, you have a more bearish global supply-demand outlook right now, which is creating a ceiling on prices. We're actually seeing OPEC Plus starting to accelerate the unwinding of their voluntary production cuts. And consensus forecasts now point to Brent crude oil prices potentially falling below $60 per barrel by the end of the year. That's a significant drop from where we've been.
$60, Brent. Okay.
However, there's a powerful dichotomy within energy itself. While long-term crude oil demand erosion due to EVs and efficiency is a theme, that AI-driven explosion in electricity demand, that's creating a near-term supercycle for power generation. And that directly benefits natural gas as a critical dispatchable fuel source needed to balance the grid.
Interesting. So the first thesis then is to underweight integrated oil companies, given that bearish crude outlook. That makes sense if a supply glut is expected later this year.
Exactly. The core idea is straightforward. Rising OPEC plus supply, coupled with slowing global economic growth, will likely push crude prices lower. Consensus forecasts point to a significant supply glut building in the fourth quarter of 2025. Brent prices projected to fall towards that $50–$60 per barrel range.
What confirms this?
We'd validate this if OPEC Plus confirms further production increases for, say, October, and if we see consistent builds in crude oil inventories reported by the EIA week after week.
Risks to that bearish view.
Well, a surprise OPEC Plus decision to pause or reverse those cuts would be bullish. Any significant geopolitical conflict that actually disrupts physical supply, or a sharp depreciation in the US dollar would make oil cheaper for international buyers, boosting demand.
Okay. But then the second, very specific and maybe somewhat counterintuitive thesis is to overweight natural gas producers because of this AI-driven power demand. Why is natural gas specifically such a critical part of the AI story, especially when we talk about clean energy transitions?
Yeah, this is where the short-term physical impact of AI really shines through, maybe counter to some longer-term narratives. The report argues the market is underappreciating the structural demand growth coming from natural gas, specifically as the primary, most flexible fuel source for AI-driven electricity generation. Why? Because data centers need power 24/7. Reliability is paramount.
May it go down?
Cannot go down. And while renewables are growing, natural gas provides that crucial grid stability and reliability, especially when the sun isn't shining or the wind isn't blowing. It's dispatchable power. That surge in electricity demand from data centers. Some estimates say it could effectively double power consumption from this segment alone by 2030. That's a huge load for the grid to handle. And the EIA, the US Energy Information Administration, actually forecasts the Henry Hub spot price, that's the benchmark for US natural gas, to rise from around $3.20 per MMBtu now to over $4.30 MMBtu in 2026. That implies strengthening demand.
So what validates this bullish gas view?
We'd look for more announcements from utilities about new power purchase agreements, specifically with gas-fired power plants. Continued strong growth in U.S. LNG exports, showing global demand. And, importantly, natural gas prices showing sustained strength relative to crude oil prices.
And the risks for natural gas.
Faster than expected breakthroughs in large-scale battery storage could reduce reliance on gas for grid balancing. An unusually warm winter would reduce heating demand, hurting prices. Or just a sharp global recession could dampen overall energy demand, including gas.
Okay, so wrapping this all up, what does this mean for you, the listener? We've really seen a market wrestling with these twin challenges, slowing growth, sticky inflation. We have a Federal Reserve on the cusp of this preemptive easing cycle, but that carries its own risks, as we discussed. And there's this pervasive geopolitical uncertainty disrupting global trade. Yet amidst all of that complexity, the AI-driven infrastructure supercycle really stands out as this powerful engine of growth. And it's fundamentally reshaping sectors like information technology, utilities, and even parts of real estate in ways we haven't seen in decades.
Indeed. And I think what this deep dive really highlights is that broad market strategies, just buying the index maybe, they might be far less effective in an environment that's defined by such significant cross currents and these deep bifurcations we've talked about. It really raises an important question for you. In a world where these macro forces, tariffs, Fed policy, and these technological revolutions like AI are so intertwined and evolving so rapidly, how do you identify the resilient business models? How do you truly understand where value is being created and, just as importantly, where it's being destroyed? It's about looking beyond just the headlines and understanding the underlying mechanics, isn't it?
Absolutely. It's clear that understanding these intertwined forces, I mean, from tariffs literally impacting what you pay at the store to AI demanding more power from our grids and reshaping entire industries, it isn't just for Wall Street traders anymore, not by a long shot. It's really about recognizing how these huge macro forces and these incredible technological revolutions are reshaping our world in real time. So the final thought for you is, how will this knowledge change the way you think about the future of industries, perhaps your investments, and the direction of the global economy?